Between 1918 and 1923, the German mark went from 4.2 marks per dollar to 4.2 trillion marks per dollar. That's not a typo. 1 trillion times devaluation in 5 years. The mathematics were simple. The government printed 1.3 quintillion marks. The currency became worthless. But here's what the history books don't emphasize. Some German families emerged from Weimar wealthier than they entered. Not by luck, not by prediction, by understanding a mathematical reality that has repeated in every currency collapse across 3,000 years of recorded history. Rome, 301 AD. The denarius lost 99.8% of its silver content over 250 years. Argentina, 2001. The peso lost 75% of its value overnight. Zimbabwe, 2008. Inflation reached 79.6 billion%. Different centuries, different continents, identical mathematical pattern. And the pattern reveals something crucial. Collapse doesn't destroy wealth, it transfers it. From those who hold paper claims to those who hold mathematical realities. The question is never if the pattern will repeat. It's whether you'll be positioned correctly when it does. Welcome to Silent Economy. We analyze the mathematical patterns that determine which wealth survives systemic failure and which doesn't. Not predictions, not speculation, just the documented mathematics of every collapse in history. Let's start with the fundamental mathematical reality. In every documented collapse, physical assets retain purchasing power while paper claims approach zero. This isn't philosophy, it's mathematics. Weimar Germany, 1923. A kilogram of rye bread cost 428 marks in January. By November, 233 billion marks. The paper price multiplied 542 million times. But the bread itself didn't change. Same calories, same nutritional value, same physical reality. Here's the critical insight. If you held marks, you needed 542 million times more pieces of paper to buy the same bread. But if you owned the farm that grew the rye, you still owned the farm. The productive capacity didn't change. Only the paper measuring system changed. The Bank for International Settlements documented this pattern across 56 currency collapses between 1900 and 2000. In every case, land retained purchasing power measured in gold or in baskets of essential goods. Bank deposits approached zero in real terms. The correlation is 1.0. Perfect mathematical consistency. Argentina provides the modern case study. Between 1999 and 2002, Argentine bank deposits lost 66% of their dollar value through forced conversion and devaluation. But farmland in the Pampas retained its productive capacity. A hectare that produced 5,000 kilograms of wheat in 1999 still produced 5,000 kilograms in 2002. The World Bank's analysis of the Argentine crisis documented that families who held wealth in productive land experienced real wealth preservation. Those who held peso deposits lost 2/3 of purchasing power. The mathematics don't care about government promises. Zimbabwe's hyperinflation proves the pattern at the extreme. Between 2007 and 2009, the Zimbabwean dollar became the first currency to require 100 trillion denomination notes. Bank accounts became worthless, but tobacco farms continued producing exportable crops. The International Monetary Fund documented that Zimbabwe's agricultural exports during hyperinflation maintained relatively stable real values in dollar terms. The mathematical principle: paper represents claims on value. Physical assets represent value itself. When the paper system breaks, claims become unenforceable, but the physical asset remains. The second mathematical reality distinguishes assets that generate value from assets that only represent stored value. This distinction determines survival in systemic failure. The Great Depression provides the data. Between 1929 and 1933, the S&P 500 fell 89%. If you owned stocks for price appreciation, you lost almost everything. But the Federal Reserve's historical data shows a different pattern for productive assets held directly. Farms that produced food continued producing. The price of crops fell 50 to 70%, but the farm still generated output. A dairy farm in Wisconsin that produced 10,000 gallons of milk in 1928 still produced 10,000 gallons in 1932. The productive capacity was mathematical reality. Contrast this with speculation. Stocks represent claims on future earnings. In systemic failure, those claims become uncertain. Courts are overwhelmed. Enforcement breaks down. The claim's value approaches zero. But a bakery that produces bread creates value independent of the financial system. People need bread. The bakery has flour, ovens, and skilled labor. It produces bread. That's mathematical certainty, not financial speculation. Venezuela demonstrates this principle at the modern extreme. Between 2013 and 2020, Venezuela's currency lost 99.99% of its purchasing power. The Caracas stock market rose 100,000% in Bolivar terms, but in dollar terms it fell 95%. Speculation failed, yet the International Monetary Fund documented that Venezuelan businesses producing essential goods, food processing, basic manufacturing, transportation, maintained relative value. They generated output people desperately needed. Mathematical necessity trumped paper value. The principle this reveals: own assets that produce necessities, not assets that depend on others paying more later. In stability, both work. In collapse, only production survives. The third mathematical reality is counterintuitive. In stable times, debt is leverage. In systemic failure, debt is catastrophic. The mathematics are simple but brutal. The U.S. Great Depression provides the data. Between 1930 and 1935, over 750,000 farms were foreclosed. These weren't poorly managed farms. Many had operated profitably for generations, but they had borrowed during the 1920s expansion. The Federal Reserve's historical records show what happened. Farm income fell 50 to 70%, but debt payments remained fixed. The mathematics became impossible. Income fell below debt service. Foreclosure followed. Compare this to debt-free farmers. The USDA's Depression-era surveys showed these farmers experienced the same income decline, but without debt payments, they survived on whatever the farm produced. Same crisis, same income shock, different mathematical position, different outcome. Argentina's 2001 crisis demonstrates the same mathematics in a modern context. Middle-class families held dollar-denominated mortgages. When the peso was forcibly converted and then devalued, peso income fell 66%. But dollar-denominated debt didn't change. The Central Bank of Argentina's data shows the result. Mortgage default rates exceeded 40% in 2002. Families lost homes they had been paying for 10 to 15 years. The mathematics were merciless. Income fell faster than debt could be restructured. The counter-argument claims inflation helps debtors by devaluing the real debt burden. This is true only if income keeps pace with inflation, but in real systemic failures, it doesn't. The IMF's analysis of 50 currency crises shows income typically lags inflation by 12 to 36 months. During that lag, debt destroys. The mathematical principle: debt is a fixed claim against uncertain future income. In stability, income arrives. In crisis, it doesn't. Zero debt means zero fixed claims. Zero claims means survival. The fourth mathematical reality addresses portability. Every form of stored wealth can be confiscated, inflated, or made inaccessible, except one: skills. The historical data is clear. Between 1933 and 1945, European Jewish families lost an estimated $300 billion in 2024 dollars through confiscation, property seized, bank accounts frozen, businesses nationalized, stored wealth approached zero. But the survivors who rebuilt most successfully shared a common factor. They possessed portable skills: physicians, engineers, craftsmen. The Conference on Jewish Material Claims Against Germany documented that skilled refugees rebuilt wealth within one generation. Those without portable skills struggled for decades. The Soviet Union's collapse provides modern data. Between 1991 and 1998, the ruble lost 99.5% of its value. Bank deposits became worthless. But the World Bank's transition economy studies show that engineers, doctors, and skilled technicians maintained relative economic position. The Soviet state and then Russian state needed their skills. Skills created leverage, even when stored wealth evaporated. Vietnam's 1975 fall demonstrates portability at the extreme. Vietnamese refugees who fled to America arrived with nothing. But U.S. Census data from 1990 shows that refugee families with professional skills achieved median income parity with native-born Americans within 15 years. Those without portable skills lagged by 25 years or more. The mathematical principle: Physical wealth can be taken. Paper wealth can be inflated. Skills remain in your brain. They're the only wealth that moves with you, can't be confiscated, and generates value in any economic system. The fifth mathematical reality concerns trust networks. When institutions fail, formal systems stop functioning, but informal networks survive. The Soviet Union's 1991 collapse provides the data. Between 1991 and 1994, Russian GDP fell 40%. The government lost authority. Banks closed. The ruble became near worthless. But Russians survived. How? The World Bank study, Making Transition Work for Everyone, documented the mechanism. Local networks of families, neighbors, and communities organized informal economies. They bartered, they shared resources, they created security. These networks became more important than the government. The data shows that individuals embedded in strong local networks experienced 30% less income decline than isolated individuals. The difference wasn't wealth, it was connection. Argentina's 2001 crisis shows the same pattern. When banks froze deposits, neighborhood assemblies formed spontaneously. These asambleas barriales organized barter networks, shared resources, and provided mutual support. The University of Buenos Aires documented that families in strong assembly networks experienced 40% better outcomes than isolated families. Lebanon's current crisis demonstrates the principle at the modern extreme. Since 2019, the Lebanese pound has lost 98% of its value. Banks have been effectively closed since 2020. The government is dysfunctional, yet Lebanon hasn't descended into chaos. Why? The International Crisis Group's analysis explains Lebanon is organized around family and sectarian networks that predate modern institutions. These networks provide credit, security, and resource distribution. When institutions failed, networks activated. The mathematical principle: institutions scale through formal rules. Networks operate through trust. When formal rules break, trust networks become the operating system of economic life. This is the kind of mathematical pattern we analyze here on Silent Economy, not tactics that work in one specific collapse, principles that work in every collapse because they're based on fundamental realities. Here's what makes these 5 realities powerful. They don't require prediction. You don't need to know whether the next systemic failure is hyperinflation, deflationary depression, or currency reset. The mathematics work regardless. Hard assets retain value because they represent physical reality, not paper promises. That works whether the paper inflates to worthlessness or deflates through banking collapse. Productive assets generate necessities. That works whether the financial system functions or fails. Zero debt means zero fixed claims on uncertain income. That works in inflation, deflation, or stagnation. Skills are portable. That works whether you stay in place or need to leave. Local networks operate on trust. That works when institutions function and when they fail. The beautiful mathematics of principles is they improve your position in stable times while protecting you in crisis. Owning productive assets generates income and stability and provides production in collapse. Zero debt increases resilience and stability and ensures survival in crisis. Skills increase earnings in normal times and provide portable wealth in disaster. These aren't trade-offs. They're position improvements that protect downside while maintaining upside. The American situation follows the same mathematical trajectory as every previous collapse. Federal debt exceeds 120% of GDP, the same level that preceded the breakdown of the Roman denarius, the assignat, and the German mark. This isn't prediction, it's pattern recognition. The mathematics are simple. When debt exceeds the capacity to repay, systems break. When currency is printed faster than productive capacity grows, paper devalues. When institutions lose trust, networks matter. These are mathematical certainties, not economic theories. The question isn't whether these patterns apply to America. It's whether you'll position according to the mathematics before the transition accelerates. The families who survived Weimar, Argentina, Zimbabwe, and every other collapse weren't smarter or luckier. They understood the mathematics. Paper burns, assets remain, debt destroys, production creates value. Skills are portable. Networks operate when institutions don't. These 5 mathematical realities have worked for 3,000 years because mathematics don't change. Human nature doesn't change. When the same conditions appear, the same results follow. If you found this analysis valuable, subscribe to Silent Economy. We'll continue documenting the mathematical patterns that determine which wealth survives systemic transitions. And leave a comment. Which of these 5 mathematical realities do you find most compelling? Or are we missing a pattern from historical collapses that matters? The mathematics work whether you follow them or not, but the outcomes are very different, positioned according to mathematical realities, not paper promises.